What if I told you that financial crises don't happen by accident? What if they're not random, unpredictable events, but instead they follow a chillingly precise repeating pattern that humanity ignores over and over again until it's far too late? When you step back and look at economic history, not with emotion but with cold, hard data, a pattern emerges. It's a cycle of boom and bust, of credit and collapse, and the dates are disturbingly aligned. Consider this sequence: 1837 to 1929 to 20, and now the cycle points directly to 2026. These aren't just random years plucked from a history book. They represent every major systemic breakdown in modern financial history, and the parallels are too strong to dismiss as mere coincidence. Let's travel back to 1837. America was in the grip of a speculative frenzy. Land values were soaring, credit was cheap, and everyone believed the good times would last forever. Sound familiar? It all came crashing down in what we now call the Panic of 1837. It was triggered by rampant speculative lending and a sudden collapse in asset values, primarily cotton and real estate. The result? Mass unemployment, bank failures, and a brutal 6-year depression that wiped out fortunes and plunged the nation into misery. People thought they had learned their lesson. They were wrong. Fast forward 92 years, the roaring 20s. The stock market was the place to be. Margin lending was out of control, and irrational exuberance was the law of the land. Then came Black Tuesday, October 29, 1929. The stock market crash that ignited the Great Depression. Again, the root causes were identical to 1837: over-leveraged speculation, a credit bubble, and a sudden catastrophic failure of liquidity in the system. The world was shattered for a decade. Now let's jump ahead another 91 years to a time we all remember vividly, 2020. The world economy spiraled into chaos, but this time something was different. The underlying conditions were the same: extreme financial fragility, massive corporate debt, and assets priced for perfection. But the crash was postponed. Governments and central banks around the globe unleashed an unprecedented wave of money printing and stimulus. They papered over the cracks, masked the insolvency, and bought time. But they didn't fix the problem. They just kicked the can down the road. 2020 wasn't the main event. It was the dress rehearsal. This brings us to today, and the ominous date that this historical sequence points to, 2026. Analysts are sounding the alarm, warning that the global financial system is repeating the exact same mistakes, but on a scale that dwarfs anything we've ever seen before. The leverage is higher, the debt is larger, and the system is infinitely more complex and interconnected. Think about the forces at play. We now have algorithmic trading that can move trillions of dollars in microseconds, creating flash crashes out of thin air. We have a mountain of sovereign debt that has reached unsustainable levels. We have AI-driven capital allocation, which concentrates risk in ways we don't fully understand. And perhaps most critically, we are staring down the barrel of the largest commercial real estate default crisis in modern history. The very foundations of our financial system are trembling. Every single collapse in this historical pattern follows the same 4-stage structure. First, a period of rapid credit expansion where money is cheap and easy to get. Second, a sharp and sudden withdrawal of liquidity where the taps are turned off. Third, widespread asset mispricing where the true value of stocks, bonds, and real estate becomes disconnected from reality. And finally, the fourth stage, a system-wide correction, a brutal deleveraging event where the mountain of debt collides with the harsh reality of deflation. That entire 4-stage process is what's forming right now, in plain sight. Interest rates have surged at the fastest pace in over 40 years, slamming the brakes on cheap credit. Those commercial real estate loans taken out between 2021 and 2023, during the era of 0% interest rates, are now coming up for refinancing at rates they simply cannot afford. It's a ticking time bomb. And the scale of the debt is staggering. Global debt now stands at over $315 trillion. That number is so vast it's almost meaningless. But here's what it means in practical terms. The system is so leveraged that a mere 2% withdrawal of capital, just 2 cents on the dollar, could be enough to trigger a cascade of liquidations, a domino effect that could bring the entire house of cards down. Many people believe that because our economy is more technologically advanced, it must be safer. They trust the algorithms, the experts, and the institutions, but the reality is the exact opposite. All this complexity has not made the system stronger. It has made it exponentially more fragile. Think of it like a Jenga tower. The more blocks you add, the more complex and impressive it looks, but the more unstable it becomes. Our modern financial system is built on layers of complexity that few truly comprehend. Derivatives, shadow banking, off-balance sheet liabilities, and the tangled web of sovereign bond interdependency have created a system where a failure in one corner can spread with unprecedented velocity, a contagion that moves at the speed of light. It is absolutely crucial to understand that 2020 wasn't the crash. It was the deferral. The trillions in liquidity injections and zero-rate policies were a financial adrenaline shot to a system having a heart attack. It kept the patient alive, but it didn't cure the underlying disease. It only allowed the debt to grow even larger, the imbalances to become more extreme, and the eventual correction to be even more severe. So why 2026? The 2026 horizon aligns perfectly with several critical pressure points. It's when a massive wave of corporate and commercial debt taken out during the easy money era comes due for rollover. It's when the commercial real estate expiration crisis is expected to hit its peak. And it's happening against a backdrop of intense geopolitical tensions and pressures for currency realignment. As nations look for alternatives to the US dollar, all the ingredients for a perfect storm are coming together. If you're still watching, I want you to understand that this isn't some random prediction or a wild conspiracy theory. This is about recognizing a cycle of human behavior, greed, and fear that has been documented for centuries. We are not immune to history. We are simply repeating it with faster technology and bigger numbers. So, I have to ask you, do you believe that crises follow these historical patterns? Or do you think this time is different, that 2026 will somehow break the sequence? Let me know your thoughts in the comments below. I read every single one. And make sure you hit that subscribe button and turn on notifications, because what I'm about to share next is critical. Now let's dig deeper into exactly how this cycle evolves, and more importantly, what the world's largest institutions and wealthiest investors are doing right now, quietly, behind the scenes, to position themselves ahead of what they see coming. You see, while the public is being told that everything is fine, the smart money is making very different moves. They are quietly rotating out of overvalued growth stocks and into hard assets. They're accumulating physical gold and silver, not as a speculative bet, but as a form of financial insurance. They are reducing their exposure to the banking system and exploring assets that exist outside of traditional financial infrastructure. They are paying close attention to commodities, particularly energy and agriculture, understanding that in a crisis, tangible goods become king. They aren't panicking, they are preparing, they understand the cycle. They see the writing on the wall, not as a source of fear, but as an incredible opportunity. Crises, as devastating as they are also periods of the greatest wealth transfer in history. Fortunes aren't just lost. They are also made by those who are prepared, positioned correctly, and have the courage to act when everyone else is frozen by fear. This isn't about timing the market perfectly to the day. It's about understanding the season we're in. We are in the late autumn of a long-term debt cycle. Winter is coming. Your job is not to predict the first snowflake, but to make sure you have your winter coat, your firewood, and a plan to not just survive, but thrive. Educate yourself. Question the mainstream narrative. Look at the data for yourself. The patterns are there if you're willing to see them. This is your chance to get ahead of the curve, to protect your family, and to potentially position yourself for the opportunities that will emerge from the chaos. Stay curious, stay informed, and most importantly, stay prepared. Let's start by rewinding the clock. Picture this. It's 1837. America is buzzing with excitement. There's a massive land speculation boom happening, fueled by what seemed like endless, easy credit. People were borrowing heavily to buy land, convinced prices would only go up. Sound familiar? But then the Bank of England, the global financial powerhouse of its time, decided to tighten its policies. It turned off the money spigot, cutting off liquidity. The result? A systemic financial crisis known as the Panic of 1837. The boom turned to bust almost overnight. Now let's fast forward to a date everyone knows, 1929. The Roaring Twenties were in full swing. The stock market was soaring, and ordinary people were getting rich through speculative margin trading, essentially borrowing money to buy stocks. But then the Federal Reserve started to raise interest rates to cool things down. This tightening of credit was the pin that pricked the bubble. The speculative frenzy ended, leading to forced deleveraging. People and institutions had to sell assets at any price to cover their debts. This triggered a chain reaction, and banks, one by one, started to collapse, ushering in the Great Depression. See the pattern? Easy money fuels a speculative bubble, and then a tightening of credit brings it all crashing down. Now, let's look at our own recent history. In 2020, the world faced a major economic shock. But instead of allowing a natural correction to happen, governments and central banks around the globe stepped in with unprecedented stimulus packages. They injected trillions of dollars into the financial system. This created artificial booms in all sorts of assets, from stocks and crypto to real estate. It felt like the party would never end. But here's the crucial part. That stimulus has now expired. The free money is gone. And to combat the inflation that followed, central banks are raising interest rates at the fastest pace in decades. We have officially entered the same final tightening stage that preceded every major crash in history. The setup is eerily similar. So what comes next, based on this historical roadmap? The next step is almost always predictable. First, we see institutional capital rotation. The big money, the smart money, starts quietly moving out of risky assets and into safer havens. Then, we see instability in the bond market, which is the bedrock of the entire financial system. Cracks start to appear. After that, funding gets pulled from high-risk sectors. The startups and companies that relied on a constant flow of cheap cash suddenly find themselves cut off. And finally, we get the domino effect, cascading defaults. Companies and individuals can no longer service their debt, leading to a wave of bankruptcies that spreads through the system. Now, let's connect this to what's happening today. Where are the most vulnerable sectors? Well, they align perfectly with this historical pattern. First, look at commercial real estate. We have record-high office vacancy rates combined with a massive wall of debt that needs to be refinanced at much higher interest rates. It's a ticking time bomb. Then there's the tech sector. For years, countless tech companies, especially those that weren't profitable, saw their valuations soar purely based on the promise of future growth fueled by cheap capital. Now that the capital isn't cheap anymore, those valuations are coming under extreme pressure. We also have emerging market debt. Many developing countries borrowed heavily in dollars when rates were low. Now, with a strong dollar and higher rates, paying back that debt is becoming crippling. And let's not forget the regional banks. Many of them have significant exposure to losses in commercial real estate and are tangled in complex derivative markets, creating hidden counterparty risks throughout the system. But this time, there's an extra layer of complexity. We have intense geopolitical stress. We're seeing pressures on the U.S. dollar's status as the world's reserve currency. The The trend of globalization is reversing, which makes supply chains less efficient and more expensive. And we're dealing with major shifts in energy costs. This combination of financial and geopolitical stress mirrors the environment right before the Great Depression, a time when multiple collapse triggers all hit at the same time. Here's a crucial insight from studying these cycles. Financial systems don't collapse when things are at their absolute worst. They collapse at the turning point, the moment when things stop getting better and start getting worse. That's the point of maximum fragility. And it feels like we can see that moment on the horizon right now. Globally, liquidity is tightening. The bond markets are showing clear signs of fracture and stress. And if you read between the lines, you'll see major institutions like BlackRock and JP Morgan quietly hedging for significant systemic volatility. They're preparing for a rough patch, specifically within the 2025 to 2027 window. It's not just them. Even official bodies like the Bank for International Settlements and the IMF are now using language like elevated systemic vulnerability in their reports. That's their version of sounding a very loud alarm. And here's the concept that most people completely miss. A real depression doesn't just start with a market crash. A crash is a symptom. The depression itself begins when the recovery fails. It starts in the stagnation phase that comes after the initial correction, when the debt load becomes truly unaffordable for the system and liquidity becomes permanently constrained. It's the long, slow grind after the panic that does the real damage. So, if you're still with me, I want you to understand this key takeaway. In a world of uncertainty, your single biggest advantage is historical awareness combined with proactive positioning. It's about understanding the game being played. Markets don't crash because of fear. That's a common misconception. They crash because of leverage. Fear just acts as the accelerator once the crash begins. On this channel, our goal is to break down these complex forces before they become mainstream headlines. We want to give you the context you need to think for yourself. So if you find this valuable, make sure you subscribe and activate the notifications. Because in our very next video, we're going to move from diagnosis to action. We'll reveal how you can strategically position yourself ahead of 2026 using the principles of historical collapse modeling and the hedging strategies that elite funds are using right now to protect and grow their capital. I want to leave you with a question to think about. Drop your thoughts in the comments below. Do you believe we are entering a new depression cycle following the historical pattern? Or will new technology like AI be powerful enough to break the cycle and push us into a completely new era of prosperity? The answer to that question may very well determine the financial reality you and your family live in for the next decade. Thanks for watching, and I'll see you in the next one.